A company that supplied chips to Apple, Tesla, and Samsung posted an 89% collapse in annual net income, yet its stock has rallied roughly 40% off the lows. Fresh off a new partnership with NVIDIA, STMicroelectronics is making bold moves to reclaim its edge in the AI-powered semiconductor race. Is the market ahead of reality? Or is STMicroelectronics the most misunderstood turnaround play in European semiconductors? Over the next few minutes, we will tear apart the fundamentals, stress test a DCF model, and give you 3 price target scenarios in both dollars and euros so you can decide for yourself. STMicroelectronics is one of Europe's largest chip makers, with one of the broadest product portfolios in the semiconductor industry. Born in 1987 from a Franco-Italian merger, ST designs and fabricates its own chips. Key customers include Apple, Samsung Electronics, and Tesla, a profile that ties ST directly to electric vehicles, smartphones, and industrial automation megatrends. In February 2026, ST completed acquisitions and broadening its sensor intellectual property and unveiled the first automotive microcontroller with integrated AI acceleration. And in March 2026, it launched a new ultra-wideband chip family for automotive and smart device applications. STMicroelectronics recently announced a strategic partnership with NVIDIA aimed at accelerating the deployment of AI-enabled edge computing solutions. While financial terms were not disclosed, the partnership signals ST's intent to move closer to the AI value chain, not just as a component supplier, but as a co-architect of intelligent systems. This could enhance ST's pricing power and deepen its moat, especially if the collaboration leads to design wins in next-generation vehicles or factory automation platforms. Growth catalysts center on 2 themes: the ramp of semiconductors for electric vehicles and AI data centers, industrial and IoT digitization via embedded microcontrollers, and a company-wide restructuring program, including the exit of approximately 2,800 positions by 2027, designed to reshape the manufacturing footprint and resize the global cost base and strengthen free cash flow generation. Morningstar assigns STMicroelectronics to narrow moat, meaning the firm's competitive advantages are real but not unassailable. To understand why this number matters, consider the 3 pillars that sustain it. First, the intangible assets consisting in patents and know-how that smaller entrants cannot quickly replicate. Second, the switching costs. The stickiness to ST products is especially strong in automotive and industrial verticals, where safety-critical certifications raise the cost of change. Last, the cost and scale considerations. Morningstar's bear case cautions that ST has a greater presence in certain types of lower-margin power semiconductors that, when combined with significant manufacturing capacity, may depress future returns relative to some of its US-based pure-play analog peers. This is the structural risk that keeps the moat narrow rather than wide. In commodity chip segments, ST competes more on price than on differentiation. On the other hand, when we look at risks for ST, the first one to consider is related to the generative AI. ST does not design the high-end GPUs or memories at the heart of the generative AI boom. It is therefore not capturing the primary profit pool the way NVIDIA does. However, ST power devices and sensors play supporting roles in data center power delivery and in AI-enabled edge devices in automotive and robotics. Morningstar highlights growth opportunities in AI data centers. ST is a secondary beneficiary. It supplies enabling components but does not command the pricing power of a monopoly AI chip designer. If AI investment slows, ST's upside from this theme diminishes more than it would for a pure-play AI supplier. Second risk is related to the Strait of Hormuz and the Middle East conflict involving the United States and Israel. The semiconductor angle is often overlooked. Qatar supplies roughly 1/3 of global helium, a non-substitutable gas used in wafer fabrication. Iranian drone strikes forced halting helium production. Beyond helium, the Middle East supplies approximately 2/3 of global bromine, over 8% of aluminum, and around 30% of sulfur, all critical to chip fabrication. For ST, this translates into higher input costs and potential material bottlenecks if the crisis extends beyond 3 to 6 months. Last risk is the chip industry itself being inherently boom and bust. Meanwhile, competition from Infineon, Texas Instruments, and analog devices in auto and industrial markets keeps pricing pressure high. If ST's restructuring program fails to deliver the expected efficiency gains, margins could remain structurally below US peers. STM trades on the New York Stock Exchange's primary listing with ticker STM on Euronext Paris and Borsa Italiana. On April 2, 2026, the New York price stood at $34.74, corresponding to roughly 30 euros. For context, the stock peaked above $55 in 2023 when trailing EPS hit $4.46, slid to roughly $20 during 2025's earnings collapse, and has since rebounded about 60%. Explaining these fluctuations on the financial side, 2025 net revenues came down by 11.1% year-over-year, with a gross margin of 34% and net income of $166 million, representing an 89.3% decline from 2024. At the peak in 2023, ST had generated more than $17 billion in revenue and $4 billion in net income. A Morningstar analyst note from October 2024 warned that the 2023 top line would represent a near and medium-term peak and cut the fair value estimate to $44 from $52 or €40 from 48. As of January 2026, however, Morningstar titled its latest report STMicroelectronics benefiting from a cyclical recovery in industrial and autos, suggesting the downturn has troughed. The current downturn has crushed ROIC to approximately 3.5% as of early 2026. Using a typical WACC assumption in the range of 8 to 9% for a mid-cap semiconductor, the spread is deeply negative, roughly minus 5 percentage points. In plain terms, ANTI is temporarily destroying economic value on each dollar of invested capital, even though it is still generating a small accounting profit. At its cyclical peak, ST earned a ROIC around 21%, with opposite conclusions on a positive spread. Speaking about dividends, the most recent annualized amount of 31 cents translates into a yield of 0.9%. Despite the profit downturn, ANT has kept the dividend intact, and the 5-year dividend growth rate is 14.14%. On a forward basis using the 2026 EPS, the dividend appears sustainable. ST's balance sheet is a bright spot, with net debt EBITDA ratio null or negative. This financial flexibility allowed ST to invest billions without material leverage risk. Regarding the 5-year EPS trajectory, the trailing EPS moved from $1.20 in 2020 to $4.46 in 2023 and 18 cents in 2025. The 5-year CAGR is severely negative due to 2025. Even with 2025 adjusted net income implying an EPS of approximately 53 cents, the trend is sharply negative, a clear reflection of the cycle rather than a permanent business decline. With a negative spread and EPS growth, the 2025 snapshot places Street squarely in the value trap quadrant. However, this label is misleading for a cyclical business at the bottom of the cycle. Consensus forecasts for EPS will rebound by more than 500% in 2026 and by an additional 70% in 2027. If realized, ROIC should climb back above WACC within the next 2 years, shifting the classification toward value creator or at minimum cash cow. We examine now ST using the price-to-earnings ratio, both trailing PE based on last 12 months' earnings and forward PE based on next 12 months' earnings. STM's trailing PE stood at approximately 63 as of late March 2026. Using the adjusted 2025 EPS, the trailing PE is still in the 60s and extremely elevated. The forward picture is much more favorable. Using the 2026 consensus EPS of $1.16, the forward PE is 30. By 2027, the implied PE drops further to 19.1. During the profitable years, ST typically traded between 8 and 22 times the trailing earnings. The current forward multiple of 30 is therefore above ST's own normal range, indicating the market is pricing in a strong rebound. Among diversified semiconductor peers, Texas Instruments trades at 41 times the earnings and NVIDIA at 47. On trailing earnings, STM is objectively expensive, but that metric is distorted by a cyclical trough. On forward 2027 earnings, it trades at a slight premium to its own historical median, but at a discount to several U.S. peers. The key question is whether the consensus EPS trajectory is achievable. This relative verdict will now be stress-tested against intrinsic value. STMicroelectronics sits in the cyclical/tech category, a semiconductor provider with exposure to both high-growth secular trends and cyclical swings. We apply a tech framework with a 2-phase DCF, modified for cyclicality. We start from the 2025 free cash flow of $265 million that should normalize higher. We use 25% growth for the conservative case below consensus and 35% growth for the optimistic case at consensus. Weighting the two scenarios with 70% on the conservative one given ST very high uncertainty, the resulting fair value is $32.80 per share. For a narrow moat company in a cyclical industry, a 15% margin of safety is appropriate. Our maximum buy price is rounded to $28 or 24 euros. The current market price of $34.74 is 24% above our maximum buy price. This suggests the stock is slightly overvalued on a fundamental basis. To verify, we check multiples. Applying the sector median forward PE of roughly 20 times to the 2027 consensus EPS of $1.82 yields $36.40, close to where the stock trades today. This cross-check implies the market is pricing ST at a reasonable multiple on 2027 earnings, effectively looking past the 2026 recovery year. There's no egregious bubble premium, but neither is there a meaningful discount. Let's look now at STM price targets under 3 scenarios: bear, base, and bull over 1, 3, and 5 years. Targets are calculated from both the current price, $34.7, and the maximum entry price, $28. The 1-year targets are sourced from the analyst consensus range, while the 3- and 5-year targets are derived from projected EPS growth trajectories and historical PE multiples for the sector between 12 and 20. The spread between buying at market and buying with a margin of safety is dramatic. In the base case, over 5 years, the annualized return jumps from 12% to 17% by waiting for a $28 entry, an extra 5 percentage points of compounding per year. What have the numbers told us? Solvency is not a concern. Enters this recovery with a net cash balance sheet and continued heavy investment. 2025 was a cyclical trough. Consensus points to a sharp snapback in 2026, with further acceleration to an EPS around $2 by 2027. At $34.74, the stock is slightly overvalued relative to our blended DCF fair value of $28 and the PE multiples. There is no margin of safety at the current price. The discipline of waiting for a cheaper entry at $28 transforms a decent return into an excellent one. STMicroelectronics is scheduled to report its Q1 2026 earnings on April 23rd. This will be the first full quarter following the Q4 2025 trough and will offer critical insight into whether the recovery is taking hold. Investors should watch for sequential revenue growth, gross margin trends, and updated guidance for 2026. Any upside or downside surprise could materially impact the valuation narrative and justify a re-rating of the stock. We recommend revisiting StockLab and the DCF and earnings-based valuation after the results are released to incorporate the latest data. If this deep dive into STMicroelectronics gave you a framework you can apply to your own portfolio, hit that like button, drop a comment with the ticker you want us to dissect next, and share this episode with someone who needs to hear it. Most importantly, subscribe to StockLab so you never miss an analysis. We'll see you in the next episode. Same rigor, different stock. Until then, stay disciplined and curious. Disclaimer: this content is provided for informational purposes only and does not constitute financial advice. Some analyses may rely on artificial intelligence tools. Their accuracy is not guaranteed. Always conduct your own research before making financial decisions.